Nice to meet everybody again. Today we continue our course in corporate finance and we are discussing the capital structure decisions. And the first part of that discussion is today, and it's focused on the trade-off framework. And I'm going to explain you why we need to look at the motives and the frameworks and concepts behind capital structure decisions. So this is our agenda for today, and we are going to start with the key determinants of the capital structure of the company. And then we need to discuss whether the debt financing has some benefits. And of course, we will discuss those benefits and think also about the pitfalls and disadvantages, potential disadvantages of debt financing. And therefore, we then move to the dynamic trade-off theory of capital structure. And I'm going to explain why it's really very important to understand at first from the theoretical conceptual point of view. And then afterwards, we are going to describe some specific impact on the value of the business of taxation and cost of financial distress. And after we discuss the conceptual framework, we need to understand how we can verify whether it really holds in some companies within some periods of time in some countries. And that's why I'm going briefly to introduce you this specific methods of verification of trade-off theory in empirical research. And then we will conclude with the takeoffs of that particular topic today. Before we proceed, we need to understand the key determinants of the capital structure, whether they are universal for all the businesses in all countries, in all periods, in all industries, or they are not universal and they are really very specific. And we need at first to determine what does it mean capital structure, because you know for sure that the company has some financing structure, it has some liabilities, other people's money, and it has, of course, equity capital. And at that slide, I'm trying to describe the differences between financing structure versus capital structure decisions. By definition in corporate finance, capital structure, this is the financing approach, the approach to the financing policy for the long-term period of time. And that's why we need that comparison. On the left side of that slide, you'll see the financing structure of any company. And of course, we can start with the total liabilities shown in the balance sheet. Among the total liabilities, there would be short-term and long-term liabilities. And among the short-term as well as long-term liabilities, we can also meet so-called interest-bearing liabilities versus non-interest-bearing liabilities, which are simple payables. Let's say this is a salary payable or taxes payable, and they do not bear any interest expense. So then we will move to the equity side of the balance sheet description of financing structure. And of course, here we can meet in some companies for some situations preferred stock issued, common voting stock issued, and of course, the section describing the retained accumulated earnings. How about capital structure? Is it the same as financing structure or not? The next slide presents capital structure. And this is the structure between the debt versus equity capital. Let's look at first at the debt side of the capital structure. You will see here only interest-bearing long-term liabilities. Why? Because by definition, capital structure, this is strategic decision which should follow the specific strategy of the company, its strategic programs for some long-term period of time. Even if the strategy, of course, can change within that long-term period, but then capital structure may also change within long-term period. So by definition, we need to understand at first how we are going to plan financing for the company for the long-term period of time. And that's why we need to understand at first interest-bearing long-term liabilities of any company. Next, we are going to look also at so-called off-balance sheet liabilities It could seem really strange because they are not in the balance sheet, they are out of the balance sheet, that's why they are called off-balance sheet liabilities. And we need to understand why are we going to look at off-balance sheet liabilities despite they are not included even in the balance sheet. To be included into the balance sheet, some liabilities, some relationship with some counterparts should follow two very specific criteria. The first criteria means that it should be really we should be really sure about the amount of possible cash outflow in some future period of time, because the liability should mean that at some point in time there would be cash outflow of the company. The company is going to pay some cash to somebody, to some counterparts. And the second criteria, we should also know not only the amount of cash outflow in the future, but we should have some precise information where it is going to happen, when it is going to happen, and what could be the period of time. If we are not sure about all of these criteria, then the accountant cannot put them into the balance sheet. And we should describe this potential relationship, which may lead potentially to some cash outflow in some uncertain future, in the notes to the financial report. But that's accounting vision. How about the finance vision? People in finance, as I tried to show you in the first class, in the first topic, they should be focused, those people in finance, on the risk level of any business. So they have to think hard whether these off-balance sheet liabilities, which are just presented only in the notes to the financial report, may mean in the nearest future that the risk of the company can increase. So it's up to their judgment where they do think that off-balance sheet liabilities may really lead to the cash outflow in the future. According to that judgment, they will consider off-balance sheet liabilities as a type of a debt, because any debt always leads to the cash outflow from the company. And the third position also may seem really just very strange, because it's about preferred stock. According to the legal criteria, preferred stock is not a debt capital at all, of course. And this is a description of the relationship between the company and the owners of the company. But they owe very specific stock, which is not voting stock, non-voting stock. Why do they buy this stock? Because they really need some periodic payments in dividends. The dividends on the preferred stock are not liabilities, strictly saying. But from the point of view of potential cash outflow, the dividends on preferred stock should be treated among the debt capital by finance people. If we now look at the equity section of the capital structure, we can see only common stock, voting stock included in the equity capital, and of course, returned earnings. Why we have here only common voting stock? Because those shareholders who are buying voting stock, they mainly are focused on the capital gain, on the dynamics of the share price, mostly, but not on the dividends. So we have to assume that the company is not going to pay dividends in cash on a periodic basis every year. It can start paying some dividends on a common voting stock, but maybe the policy of dividend payments for the preferred stock, shareholders, of course, that policy should be very, very different. Later in the course, I will show you that dividend policy and all the arguments behind the decisions how to pay cash back to the shareholders. So why the capital structure finally really differs from the finance structure? Let's summarize, let's conclude. When it comes to finance structure of any company, the information that we can find in the balance sheet describing the finance structure of any company is based on the principles of law. It is based on the principles of the property rights. And of course, accounting treatment, some particular standard of financial reporting, how you're going to account for the transactions, how you're going to disclose the information in the financial report, also follows this legal criteria and reporting standards. On the contrary, capital structure does not rely on the legal principles and does not even rely on reporting standards. But what is the main criteria to decide about the components of the capital structure? It is risk criteria. So the finance person, the finance analyst, should think hard about the cash outflows and the probability of the cash outflows in the nearest future, and the probability of a decrease, potential decrease, in the so-called coverage ratios when the finance person will compare cash outflows to the debt service, to the interest expense and principal amount of debt, to the debt service overall. And it's really very important to understand whether, let's say, of balance sheet liabilities I described a minute ago can lead to the decrease in the coverage ratio. If the coverage ratio is going to be decreased, then it means that the risk of the company is going to increase. And that's very important from the finance point of view. And it's not so important from the point of view of accounting treatment. And then, of course, accounting treatment also is not focused on the strategic risk, but the finance approach to the company analysis, as I showed in the topic number 1, should be focused on the risk and on strategic risk of the business. And that's why when it comes to the capital structure, we need to bear in mind at least cost of financial distress that may happen if debt is too much for that potential cash inflows and outflows from the company. Now we are going to discuss the capital structure determinants. What determines the financial leverage of any company? Remember, I put a question whether these capital structure determinants are really universal or they are very specific for each particular company. That slide represents very important result of well-known research made by Ryan and Zingales, and this is very interesting paper. And it shows that financial leverage can be explained by 4 different determinants. The first one is so-called tangibility of assets, or the proportion of tangible assets as compared to the average assets of the company. Why it's so important? Because in many situations, when you look for additional debt, bank debt or corporate bonds issue in the future, you, of course, at first should think about the collateral, about the assets behind that debt. The second very important determinant, the market-to-book ratio. The market-to-book ratio, this is the comparison of the market value of the equity to the book value of the equity. And the market-to-book ratio here, in that equation about the determinants of the capital structure, could be treated as the metrics for the growth opportunities. If the market-to-book ratio is well above 1, then we may say that investors really appreciate the company's strategy and they really do believe that the company is going to grow and the company will have additional growth opportunities, additional investment projects, and it will capture additional market niche and additional clients in the market. So if the market-to-book ratio is well below 1, then we may say that investors do not think this is a promising company and the share price maybe is not going to increase. So that's really very important determinant number 2. The determinant number 3, the sales or natural logarithm of sales. This is like a proxy for the size of the company. The bigger the company, maybe the higher the leverage, who knows? But we need to check that relationship first. But we can also explain that why the size may become important. Because if the company is bigger, it says that maybe this is not the company at the entry stage of the life cycle. Maybe this is the company which is already at the growth stage or at maturity stage, in a life cycle. We will be back to the determinants and their explanation later in that class. And the fourth determinant, this is return on asset, the coefficient which compares earnings before interest and tax and to the average assets. So these are four well-known in empirical research literature capital structure determinants. Can we add something to that picture? In some other papers, empirical researchers found that in many situations we can add two additional drivers at least. The first one, mean industry financial leverage. We can say that if it is statistically significant in the regression analysis of the equation that we presented in the previous slide, then it might mean that the product-market interactions and the level of the competition may lead to the need to follow almost similar policy in financing as the most successful competitors are making when they are making their capital structure decisions. In some situations, it may also mean that mean industry leverage just captures some additional effects of some other variables not directly related to the intensity of the competition in the product markets. And it's so-called omitted variables. We still don't know precisely what is the variable behind, but the mean industry leverage, when it becomes statistically significant, may just capture this additional influence on the capital structure and financial leverage of the company. And the last one, but not the least, expected inflation rate. Why? Because when inflation is really high, then the cash outflow, which you need to assume when paying your taxes, first income taxes, of course, of any company, they would be higher in case of higher inflation. And then we need to summarize that, of course, the empirical research shows that there are 4 + 2 additional capital structure drivers behind the decision about the level of financial leverage. In many papers, empirical results show that with the positive sign, statistically significant industry leverage, asset structure, which is called tangibility or tangible assets to total assets, the company's size and the inflation rate will explain financial leverage. Positive sign means that the higher any of these determinants which are listed here in that slide, the higher financial leverage. But some of those determinants, let's say growth opportunities and profitability, in many empirical papers, they will show statistically significant negative coefficients, which will mean that the higher growth opportunities or the higher the profitability of a company, the lower would be financial leverage of that particular firm. It is very important to bear in mind that individual effects of the companies which are included into those samples for empirical research to understand the impact and the influence of capital structure drivers on the financial leverage coefficient, that those individual effects they explain a high proportion of the variation in financial leverage in many companies, in many empirical papers. Second very important point, that's the lesson from the empirical result. In many situations, we have to assume that there could be non-linear relationship. And it will mean that up to some break-even point, let's say some determinant may influence positively financial leverage, but beyond that break-even point, the negative trend may start. And finally, we also need to point out that the difference in this science in different empirical research papers which cover different samples, different nations, different periods in time, the different science for the statistically significant explanatory variables may mean that the sample contains some companies with very different motives. So, to say it in other words, the sign of the universal determinants may differ in different research empirical papers. That will mean that the samples in those papers, the companies in those samples, in those papers, they may follow very different logic when developing long-term financial policy. Finally, it is very important to understand that when we are looking at the behavior of that coefficient, financial leverage, at the national level, we have to notice that empirical papers, they show more or less stable average financial leverage for the long period of time. And they also show a very interesting event, which is called mean reversion of financial leverage, which means that the leverage may increase and then in some period of time it goes back to the previous values. That situation can be repeated within the long period of observation, even several times. It could be, of course, explained, that mean reversion, that within this long period of observation, some new companies appeared. They are at the entry stages of their life cycle of organization. Some companies are disappearing from the business because they are now at the exit stages in their life cycles. So some companies which enter, some companies which exit, they may change, of course, the overall picture of financial leverage on a national level, and that also can explain that mean reversion effect on the national level. The next very important point, on the national level, when the researchers are trying to explain why we can observe the stable average financial leverage and why we can observe this mean reversion, it could be explained just via the transactions with the debt, with the new issues of corporate bonds, or with the repayment of the debts, bank debts as well as corporate bonds. And the last but not the least, in the emerging capital markets, of course, in many research empirical papers, the authors will also arrive to the conclusion that the mean reversion at the national level in the emerging capital market of some particular country is due to the life cycle. Because some companies are entering their markets, some companies are already exiting their business cycles. But what's really important in emerging capital markets, the major role, the major influential factor is related to the global trends in the global capital markets, more than to the internal developments and trends in the internal debt market within particular emerging capital national market. Now we need to discuss how we can measure the benefits of debt financing. And the first very important point is related to the interest expense, of course, because any debt will bear interest expense. It could be coupon expense on the corporate bond or interest expense when the company has some bank loan. And the first step will mean that the interest expense is deductible when you are computing your taxable profits to pay the income corporate tax out. And then at the first step, if we want to measure the so-called tax shield or amount of money that the company is not going to pay in the income taxes due to the interest expense, at first we need to understand the amount of interest expense itself in absolute terms. At that slide, remember, what we are doing, this is simplification because we are now looking for the measurement of the tax shield only for 1 year period. The second step, we already said that due to the deduction of interest expense, some profits will not be paid out in taxes. So then the value of the tax shield only for 1 year period would be the result of interest expense in absolute terms multiplied by the corporate income tax rate. So that expression captures the amount of profits that the company will leave inside and the amount of cash which the company is not going to pay out in taxes. That's why it's called tax shield. But how about the multi-period model? Now we need to go beyond 1 year. And at first, we need to discuss very simplistic model. What is the simplification? The simplification is based on the assumptions that I'm going to introduce here at that particular slide. The first assumption, let's assume that the companies we are looking for when we want to measure the tax shield stream beyond 1 year, they are not changing their operating policies. They are producing the same products with the same technologies, they are functioning in the same markets, and the customer profile stays also the same. The second important assumption here for that simplistic model says that the companies are not growing. So they are having just stable amount of revenue and stable output in terms of their products and services. And the third very important point, the companies, because they are not growing and they are not changing their operating policies, they are not going to change their financing policy. So why do we need this very simplistic picture with all these assumptions, which of course are not realistic? Just to understand the logic behind the computation of the value of the tax shield stream beyond 1 year. And if we apply those assumptions, then we can come to the conclusion. The operating risks of the company will stay the same. And because the company is not also changing financing policy, we may also assume that the financing risks are also the same. And then the amount of a tax shield now becomes the perpetuity or annuity, which is equal sum of cash going forever. Every year, the same permanent amount of cash. So the value of the tax shield, which we express for the 1 year period, which is shown at that slide, now should be treated as annuity going forever. And then our next step would be just to try to find the value of the benefit stream of the amount of the tax shield which becomes equal, which becomes annuity going forever. And that equation shows that in that case we need to capitalize that annuity which will last forever. To go through that exercise of capitalization of perpetuity or annuity which lasts forever, we need in denominator the required rate of return. But remember, due to our assumptions, when we assumed operational risk is not going to be changed and the financing policy also stays the same, then we can assume that the required rate of return of the creditors of the company, bondholders or banks, will be also the same for all these periods. So that's why that required rate of return will be equal to the interest rate if we are looking at the bonds, if we are looking, at the bank loan, or it would be equal to the coupon rate for the bond. And that's why now we can find this expression and explain it. The value of the tax shield, which goes for even for forever, due to our simplified assumptions, will become equal to the product of debt multiplied by corporate income tax rate. At that point in time, we already know how to measure with simplifications the benefits of debt financing. And that means we can proceed to dynamic trade-off theory or conception of capital structure. Let's explain with this graph. If we just pick up two very similar companies in terms of their operations, they are producing similar products, they are competing in similar markets, and they have almost the similar size and operational policy, but they will differ, these companies, by their financing policy. So if we can now assume that we somehow can understand the value and measure the value of the company which does not apply any financial leverage, this would be value with the symbol U. The value of unlevered company, this is the discounted cash flow at some rate which expresses operational risk of that company. On opposite, the company which differs by the financing policy, which at that point of our discussion applies financial leverage for the long-term period to follow its strategy, but it's the same with a similar operational profile. The value of that company can also be understood at first by comparing it to the value of unlevered company. But because of the tax shield or cash flow stream, which will last forever with our simplifications, which will still be kept by the company, they are not paid out in income tax, and these are additional cash flows lasting forever in very equal installments year by year. They are kept within the company, and we already expressed the value of all these equal tax shields going forever. So we have to add now that value of a tax shield to the value of unlevered company, because the value of unlevered company also only captures the cash flows which are due to the operations of the company. And because that company, which is unlevered, does not have any debt in a capital structure, it does not pay any interest or coupon expense, and that's why it does not have any tax shield due to this specific financing policy. And then the graph can show us that comparison, that the value of the company which is levered will be higher than the value of the company which is unlevered. And the higher than the debt to equity ratio, which is the expression for the financial leverage of the levered company, the higher would be the value of a tax shield which lasts forever with our simplifications. But at some point in time, of course, when debt to equity ratio raises significantly, it may happen that company which is applying financial leverage will incur the costs of debt financing. And there will appear the cost of financial distress. And somehow we need to understand a little bit later how we are going to measure the value of the cost of financial distress. But that equation now, even with these simplifications, captures very important point behind the trade-off theory. So it says, when you are applying debt financing, you will at first get some benefits. If you continue increasing your financial leverage, your benefits will also increase. So you will get your marginal benefits because you continue increasing your financial leverage. But with each step in increase in financial leverage, you will incur additional costs of financial distress. This would be marginal costs of financial distress. So going step by step, you have to balance your marginal benefits and your marginal costs Your marginal benefits, this is the plus to the value of levered company. Your marginal costs, this is a deduction from the value of the levered company. Moving forward, we need to summarize the principles of trade-off argumentation or explanation of capital structure choice. So we already said that the marginal benefits may increase because they are due to the tax shield streams. We already said that the marginal costs will increase if the company is increasing debt to equity ratio. So we need to understand that these marginal costs could be related to the so-called misfortunes for business operations, to the threat of potential future bankruptcy. And that's why the company which applies debt in its capital structure decision should be really very cautious. So the trade-off conception explains the power of cost of financial distress and the benefits and the value additions due to the tax shield. And it says that the motivation behind capital structure choice for some companies could be just find this proper balance between the marginal cost and marginal benefits of debt financing. Stu Myers summarized several principles as well as some discussion points in trade-off conception behind capital structure decisions. And here at that slide, I'm showing these very interesting points. They are called discussion points just because you need to verify this with different samples for different periods in time. You will find very different answers because not every company maybe is following that particular logic of capital structure decisions. But if the company follows that logic, according to the trade-off conception, it says first that then the company should set up a target debt-to-value ratio or a target financial leverage or a target capital structure for itself. And then after setting up that target level of capital structure, every company which follows that motivation behind long-term financing policy will gradually move towards the target capital structure. Second very important point to be discussed, but that target capital structure level is not very easy or directly observable. It is a bit uncertain because target capital structure also depends on some balance of benefits and costs. And when competing in the actual market, but without this very simplistic assumptions we already introduced several minutes ago, we need to say that the target capital structure, of course, may vary in the nearest future. So you need to be very attentively observing what's going to happen. What are the determinants of your target capital structure? And what is the interaction between those determinants according to the changes and the shifts in the competition in your product market, intensity of that competition. So the balance of benefits and costs on particular level of the target capital structure may also change. And finally, according to the trade-off conception, if you have that target already set up, you just step by step gradually are moving towards the target capital structure due to the transaction costs, because it's not a costless operation just to get the new level of a capital structure. You need some additional transactions. And that's why the discussion point also will concern the different adjustment parts. May it happen that when moving gradually to your target capital structure, you will bear just permanent costs each year, step by step, or it's going to be just one-time upfront costs. It depends on the sample. It depends on the technique of the empirical research. Some researchers will say, yes, there would be some permanent costs. In some other papers, we can come to the conclusion, no, this would be just on-time, upfront, one-time costs. And the second discussable point is whether these transaction costs are dependent on the amount of the debt you need to change, increase or decrease to get to your target capital structure. And that's why we can say maybe the transaction costs are going to be fixed, or they are variable costs because they are dependent on the amount of debt you need to add or you need to repay just to be closer to your target and capital structure. So let's summarize the principles of the dynamic trade-off conception. So the company is going to find that balance between marginal benefits and marginal costs within several periods. And that's why within this long-term period, the company moves steadily to the target financial leverage. And it is doing this way on a systematic basis, which means that the company financial managers should be very carefully watching the determinants of the target financial leverage because it will vary in the nearest future. Then it's also very important to say that the financial leverage is going to be changed somehow, and you need to explain all these changes and foresee these potential changes in the future. And finally, each company will have some speed of adjustment to that target level of capital structure, which moves or drifts itself somehow under the impact of some particular determinants. And that's why we can also assume that the mean reversion effect that we already mentioned at the very beginning of our class could be or even should be described by the trade-off conception. How about the model and the solutions for the model? And I'm going to refer to a very important paper written by Goldstein et al. And by Fisher et al., two different but very interesting papers on the dynamic trade-off. What is the summary from these interesting conceptual papers? So the drifts in the capital structure would be observable, and the delays in adjustment to the target capital structure will be also observable due to the difference in transaction costs. Next very important point, even in case the transaction costs at some particular period are not high, they are even low, it will result in the deviations from the prescribed, predetermined target capital structure. And if the leverage gets too far from the target level, then the company should undertake the rebalancing, and it would be discrete action when the company is rebalancing the capital structure, moving towards the target level. And according to these conceptions, there should be some minimum and maximum boundaries when the company is starting rebalancing. So only when the company reaches the lower limit or the upper limit in this range for the target capital structure, then the rebalancing arrives. And when it comes to the rebalancing, if the company earns enough profit, then the company is going to repay the debt, and then the leverage will decrease. When the leverage comes to the lower limit, then the company should recapitalize or attract additional capital. The company may attract additional debt at that point in time. If the debt increases, then the company permits to drift towards the new level of a target capital structure until it reaches the so-called upper limit. And the transaction costs which company will incur when moving towards the target capital structure and drifting towards the target capital structure, those transaction costs will delay that rebalancing and lead to a wider variations in the level of the leverage around the target capital structure. And the greater the volatility of the business of any particular company which follows that logic of financing, the higher would be the range in which the company permits those drifts between the upper and lower limits in the deviations from the target level of the capital structure. And even the greater the volatility of the company's business in its product market, the higher could be the impact on the target capital structure itself. And according to this model, greater volatility can lead to the reduction of a target level of a capital structure when the boundaries are already reached. So the company which suffer from that greater or increased volatility in its operation will set up new target capital structure at some lower levels than it was done before. And finally, which is really very important, the empirical data which followed that approach in dynamic trade-off reflected the drifts in capital structure rather than some very active rebalancing, which the huge shifts in the level of the financial leverage. And following those principles according to this model of dynamic trade-off, we then can say that the capital structure which exhibits the mean reversion on the national level really can be explained by the trade-off conception at a firm level as well. Due to these adjustments to the target capital structure, due to these drifts to the target capital structure, due to the impact of the competition and the volatility on the target level itself and on the range between the lower and upper limits in the deviations from the target capital structure. Some researchers can show, and they really showed, and they really concluded that the adjustments could be also fast. About 2 to 3 years it may take to adjust to some predetermined target level of capital structure. But what is really interesting, the speed of adjustment may really differ between the companies which are paying regular cash dividends to their shareholders and those which are non-payers. According to the research of Fama-French, we can now see here on that slide that those which are not paying, their speed of adjustment is 10 to 15 percentage points higher. Those who are paying the dividends to their shareholders, they will have the lower levels of the adjustments to the target capital structure. Now we are going back to the benefits of debt financing, because at the first stage we just introduced only the income corporate tax rate. What's going to happen to the benefits of debt financing in case of personal taxes? The company has two different types of investors. The debt holders are going to pay their own taxes on the income they will get from the company. From the bank loan, they will get interest expense. They should pay their income tax. If they are owing corporate bonds of that particular company, they will get their coupon paid by the company, and therefore they also need to pay finally their income taxes. The second type of company investors are, of course, the shareholders of the company, and when they get their dividends from the company, they have to pay their personal, individual income taxes. So now we are trying to understand the so-called Miller model, and it concerns the interaction between the corporate income tax rate and different rates paid in taxes by different types of company investors, debt holders, and equity holders. Remember, we already explained the equation how the value of the company which is levered differs from the value of the company which is not levered or is unlevered. And we already showed that the value of a company which is levered is higher by the value of the tax shield. Here, in that particular equation, we also see the value of the tax shield, but we are relying on the Miller adjustment, and it's based on the three different tax rates for company, for debt holders, and for equity holders. So what is going to happen if we are introducing personal tax rates for different types of investors? At first, we need to say that only in case when personal tax rates for debt holders and equity holders are really equal, then the tax shield becomes really absolute benefit, and the value will increase for the company which is levered as compared to the company which is unlevered. What is going to happen if it's not the case? If the tax rates are of different types of investors are no more equal, then the tax shield is no more benefit for the company in each particular case. So we need to be more attentively looking at the combination of the different tax rates for two different types of investors. And only if adjustment itself is above zero, the new debt becomes attractive. And if adjustment is below zero, then the debt is not attractive. The last situation will arrive if your nominator in the formula in that slide is higher than your denominator due to the combination of the three types of tax rates: corporate tax rate, debt holders tax rate, and equity holders tax rate. From that follows that the benefits of tax shield and the benefits of debt in some situations will really add to the value of the company. But in some situations, they cannot create additional value to the company which is using financial leverage when financing long-term programs and long-term strategies. So the financial leverage, is it a magic tool? To summarize our conclusions, even if we can assume that on a pre-tax basis, the cost of debt or required rate of return of debt holders and the cost of equity or required rate of return of equity holders are really equal on a risk-adjusted basis, even in this case, debt is cheaper for the company on an after-tax basis due to the tax shield. But the debt will become beneficial for the company only with the particular combinations of three different tax rates: corporate tax rate, personal tax rates for debt holders, and equity holders. And we also should say that the benefits of financial leverage will decrease if the company already has some other sources for the large tax shields. And then the tax shield due to the interest expense is not as attractive as it could be. Which particular other sources of tax shields the company may have? Let's say the company has huge depreciation expenses. Those non-cash charges, they will also become the tax shields when computing the income taxes for the company. So if the company recently bought very expensive and really high-tech property, plant, and equipment, and it has them on the balance sheet, so the depreciation expense would be really big, really huge, and then in that particular situation, the debt tax shield relatively becomes not as much attractive. So the financial leverage is not a magic tool forever. The financial leverage could be a magic tool in some situations, but not in every case and not in every situation, not in every country, not in every period, due to this interaction of the tax rate and due to very specific particular assets in some companies, due to their restructuring policies or some other operational policies of the business. There are some empirical studies, of course, which are trying to verify the value of the tax shield in actual business. Look at that particular slide. The paper written by Graham introduced specific modeling function for the tax benefits, how they could be computed. And it was then applied to the sample of companies. And finally, the author came to the conclusion that the value of the tax shield, or this addition to the value of the company with the financial leverage, may become equal about to 9.7 or 10% of the market value of the firm due to application of that modeling, which is not as simplistic as we showed at the beginning of that class. If we just use some simple, more simplified approach without different scenarios, the value of the tax shield becomes even higher. It's about 13%. So the value of the levered company will become by 13% higher than the value of unlevered company, but similar from the point of view of operations and output and the size. Next, but if you introduce, or if a researcher introduces the adjustments to the different personal tax rates for different types of company investors, then you may see here then the value that will arise from the tax benefits will be lower, much lower, could be 4 to 7% of firm value, but not 9 or 10% as in the previous case. What does it mean for practical people? What does it mean for financial specialists in the company? The finance people must be very accurate when considering the debt. I think now we can prove it even with the empirical studies. Okay, we already discussed the benefits of debt. We also tried to illustrate how it could be measured. And now it's time to switch to the cost of financial distress. We can divide the cost of financial distress of any company which has some debt and capital structure into different types. The first is so-called direct cost of financial distress. It can be explained through the cash outflows the company will incur at times of bankruptcy. The company is going to pay some fees to consultants, to the lawyers, to renegotiate the debt terms and the debt agreements and try to postpone the bankruptcy procedure. So these are more or less evident cash outflows that the company should meet at times of bankruptcy. But what is really more serious and really less evident, these are the indirect costs of financial distress. And moreover, I would say those are really most dangerous parts of the cost of financial distress. And in our discussion, I would like to subdivide the indirect costs of financial distress into two different parts. The first part is a description of the conflict of interests between debt holders and equity holders. And it is due to the shift in the behavior of the equity holders and the company. And the second part would be a description of the changes in behavior of the non-financial stakeholders of the company. To summarize, I would again say the indirect cost of financial distress, they are related to something which is not quick, which is not fast coming, which could be postponed for some period in time, and it's not really evident because it is due to the changes in the behavior first of financial stakeholders, mainly equity holders, and then also to the behavior in the non-financial stakeholders. So first, we are going to illustrate, of course, the shifts and motives in the behavior of equity holders. And I'm going to list at least 3 different types of events. The first one is called debt overhang. And it says with this notion, with this term, that the financial leverage of some particular company is really too huge for that company. It cannot service the debt as it was before. And all the problems with the coverage ratios, which compare the cash flows to the amount of money that companies should pay to service the debt, the coverage ratios are already decreasing. And it says that on opposite, the risk is increasing. So what does it mean, this debt overhead, in terms of the behavior of equity holders and the changes in their motivations? Debt overhang means that the managers and the equity holders, they will cancel or just decline some projects which are effective projects, which are net present value positive projects, because to initiate those projects, they need additional financing, and it is almost not possible to get additional debt. And if new debt even will come to the company, then it will capture the most proportion of the future cash flows from that net present value project. The debt overhang may also mean that in case the company already has senior debt, which always has some collateral and the assets of the company behind that contract with the senior debt holders, in that case, the company will not be able to obtain additional financing in terms of the senior debt, because all the assets which are valuable are in that collateral for the first senior debt holders. But the company will need to repay the previous senior debt from the subordinated new debts. The subordinated new debts means that they are more risky, no collateral behind, and the interest expense or required rate of return of these new debt holders will be really higher. So we also can mention that among the debt holders, there would be some specific behavior, which in the academic literature in corporate finance is called free riding behavior, which says that the senior debt holders may become reluctant to support the new investments that the company is planning and to provide new portion of senior debt. So if we summarize all here, then starting with the first statement, the company may decline or even cancel future investment projects. We have to say that overhang will lead to the underinvestment of the company. And sometimes even the term debt overhang is used as the synonym of underinvestment of the company. What does it mean in terms of the value creation? At first, we need to say it means that the value of a business would be redistributed between the debt holders and equity holders. There will be the decrease in the market value of the debt capital of a company, or even it could be also the decrease in total value of the firm when the equity, the market value of equity can also decrease due to the higher investment risk. The second very important event, which also can illustrate the shifts in the motives and in the behavior of equity holders, is related to the short-termism in the policies, especially in the investing decisions of the company. And to explain it, we needed first to say that in that type of the shift in the behavior, the managers will prefer low net present value projects, less effective projects. If those projects will pay off the investment faster, they will have shorter payback periods. They will need those low NPV projects, but with the shorter payback horizons, because they will generate cash faster. And the cash is needed to repay partially at least the long-term outstanding debt, which is now too high for the company. And of course, we need to summarize saying that there could be some gain to the shareholders if they initiate that new, even less effective net present value project. But that gain will come at the expense of the existing debt holders with the longer term maturities of the debt. So again, we need to say there would be redistribution of the value of the firm between the debt holders and equity holders, and the decrease in the market value of the debt of a company, or the decrease in the market value of the equity capital of the company may also happen. And then the total value of the company will decrease. The last but not the least, shift in the motivation and the behavior of equity holder is related to really opposite opposite direction shift. In previous 2 points, we were talking about some decrease in the investments or even under-investment cases in the business. But here we are going to say about so-called asset substitution or risk shifting, which means that is going to happen the change in the risk profile of the assets of the company. There would be additional incentives to the shareholders and to the managers to implement more risky projects. Why? For the shareholders, there would be so-called unlimited upside in the cash flows in the riskier projects. Why it is unlimited? Because if this risky project is really successful, the risk of the project will mean, and if it's higher, then we expect the higher levels of the cash flows is compared to the projects with the lower level of the risk. But the shareholders will get that benefit to the business in terms of the additional higher cash inflows due to these much riskier projects. But in case the project is not lucky, is not very successful, the shareholders will have so-called limited liability at the downside. In case of the unsuccessful implementation of the project, their liability is limited by the total sum of the par values, nominal values of their stock, of their shares. So we are going to say that the shareholders and their managers will prefer high-risk projects, even in case net present value of those projects could be really low, or in some situations even negative, which says they will prefer high-risk projects even if the project is not effective at all to the less risky net present value projects. And it also may happen that at some point in time when it is almost clear that the company is fast going to the bankruptcy situation, the equity holders may refuse to liquidate the business before the company arrives to the bankruptcy case immediately. So it would be, let's say, too late liquidation procedure. Why it's important to mention this even too late liquidation procedure? It's important because if the shareholders vote for the liquidation when the situation is less evident to the outside investors, to the capital market, the assets that they can sell when liquidating the business will have an opportunity to get higher market prices, and the shareholders therefore will get higher cash inflows for this process of liquidating the business. But if it's done too late, when it is really very evident the company is just one step to the bankruptcy procedure, then the market prices for the assets will be much lower, and the total amount of cash extracted derived from the liquidation procedure is going to become really much lower. So to summarize what we are going to say here, this first type of cost of financial distress, which is related to the changes and the shifts in the style of decision making, in the motivation, in the behavior of equity holders and the executive team of the company, will mean that often many cases will happen at the expense of the debt holders. The second component of indirect cost of financial distress could be described by the activities of the company harmful to the non-financial stakeholders. So it's really very important to say that not only financial stakeholders are changing their style of decision making, but non-financial stakeholders of that particular firm will also change their attitude toward the company and their decision making, because those are counterparts of the company and its business. So the cost of financial distress may involve the changes in the customer behavior and customer perception of the future perspectives of that business, and many customers may try to find new suppliers and get rid of that particular firm products. It may also lead to the changes in the supplier perceptions and stricter terms to protect those suppliers in their agreements, and they will try to rewrite the agreements with the company. So it may also mean that the top personnel of the company, which have the highest expertise and experience in their industry, they will get their own fears, and some of those people on the top level will try to leave this business and to find the new job and new opportunities to build their professional careers. It will also lead, of course, if we summarize all these negative events that are going to happen due to the very high financial leverage and very high cost of financial distress of some particular company, will mean finally that the required rates of return have increased for that company from the point of view of debt holders and equity holders, because there would be some harmful consequences to the operations of the company, the increase in the volatility of the financial results of that company due to the changes in the behavior and decision-making of non-financial stakeholders of the business. So those losses in the revenues, in the profits, and the cash flows will be the results of a much weaker competitive position of that particular business. We looked at different components of the trade-off framework. We discussed and explained how we can quantify the value of the tax shield, which show the benefits of debt financing, how we can quantify the value of the cost of financial distress, how we can verify whether really the cost of financial distress will be evident to the outside investors in the market. But at that stage of our discussion, what I'm going to do, I'm going to show you how the overall trade-off framework of capital structure choice can be empirically verified by the researchers. And there are two, at least, different approaches or methods. And the first one is related to the analysis of the determinants. We started our class today with the question of whether the determinants for financial leverage of the company are really universal or there would be some specific. So the first method is going back to the idea of the determinants and the coefficients and the signs of those statistically significant coefficients in the regression analysis. So in all the research papers, people who will run that empirical studies, they need to provide their understanding which proxies they are going to apply. And of course, when you are looking at the trade-off idea, which says you need to find the balance, the proper balance between your marginal benefits and marginal cost of debt financing, of course, you have to assume that the business risk of the company should matter for that decision about the amount of debt in your capital structure. And to approximate the business risk in the empirical studies, in the regression analysis, you have to pick up some particular variable. And in most cases, it would be earnings volatility, standard deviation of the earnings of the company. Many researchers will also assume that if the company has unique business model, unique resources, then the company, of course, will consider that uniqueness in making the decision about the debt, because that particular type of companies, they will be really vulnerable to the cost of financial distress. I already showed you that even the behavior of non-financial stakeholders, their customers, the suppliers, and the top personnel, which have professional expertise, may change due to the perception that the leverage of the company is too high. So to pick up the idea that the uniqueness of the firm, of its business model, can impact the decision about the capital structure choice and the amount of debt, and the decision how to balance the benefits versus the marginal costs of debt financing, it should be incorporated into the regression analysis. So to pick up that idea, the researcher can apply different metrics. Let's say research and development expense related to the sales, marketing expense related to the sales revenue, advertising expense relative to the sales revenue. Why? Because if the company has intangible assets in the business model, and in its competition, it is relying on these intangible resources, then the company is very keen on R&D because it's going to develop new technology and new products. Then the company is very carefully working with the market, and that's why it can increase the marketing expense on a periodic, regular basis and increase the advertising expense, so on and so forth. So the higher all these coefficients, the higher the uniqueness of particular firms in the sample. Third, growth opportunities, market-to-book ratio. This is a good proxy. I already explained it at the beginning of the class. If it's above 1, or let's say above some mean value in the particular sample, then we may say that this is the subsample of companies with really high growth opportunities, and the opposite subsample with the market-to-book ratio, which are below the mean, and that overall sample, they will not have nice or attractive growth opportunities in the future. And last but not the least, the profitability of the company, the return on assets of the company. So then researcher will pick up some variables, build the equation saying that the financial leverage of some companies should be dependent on those variables, and then we need to understand finally what is the relationship, and we need to run these tests. So in those types of empirical verification, and there are many studies of that particular type, researchers will find different types of the relationship. If we look at how the growth opportunities can be related to the leverage of the company, in most cases, in most studies, empirical, we will get the negative statistical significant relationship. So that's because the company which are growing, those companies will lose more value due to the very high sensitivity to the cost of financial distress. For those types of companies, the problem of the debt overhang or underinvestment is really more severe, and they will of course prefer less debt, because if you have high debt, there would be some incentives to invest in risky projects and bear entire cost of the projects. So for those companies, their sensitivity to the potential debt overhang will lead them to some lower financial leverages, and then the negative relationship between the leverage and the growth of the company would be explained. These particular types of companies also can suffer from the asset substitution problem and be really more sensitive to the asset substitution problem, because asset substitution says you will prefer high risky or riskier types of investments, but the high growth rates of the companies will lead to the increase in the risk. So the debt holders, of course, of those companies cannot easily understand and detect how the risk is going to be changed and how the market value of debt can be changed. It's not very evident, and that's why the debt for those companies will become more costly. And again, the asset substitution sensitivity of this fast-growing company will be additional argument to explain the statistically significant negative relationship between leverage and growth of the company. If we look now at the relationship between the leverage and the size, in these studies, which are trying to empirically prove whether the trade-off really holds for some particular samples, for periods of observation in some particular countries, we may also arrive at the conclusion that in some studies there would be a statistically significant positive relationship between the level of the leverage and the size of the firm. We can also, of course, explain it by additional argumentation, saying that big companies will have a lower default risk because in many situations those big companies are closer to the maturity stage in the life cycle, and they will have their product portfolio more diversified than the companies which are at, let's say, at the growth stage, or even at, of course, at the entry stage. We can also say that the large companies which are at the growth stage of their life cycle or at the maturity stage of their life cycle, they already have a good reputation in the debt markets. That's why these are the arguments to say that in some samples we can find positive statistically significant relationship. The higher the size of the business, the higher the financial leverage. But in some studies, researchers arrived to the negative statistically significant relationship. And then we may say that maybe in that sample, we will have lots of companies which are at final stages of their maturity. Of course, they are better known, but they are very close to their last or exit stage in the life cycle. And at the final stage in their maturity in life cycle, all companies do not have many growth opportunities, many investment opportunities due to specific situation inside that particular business and due to the competition drivers in their product market. So being very close now to this downward trend in the life cycle curve, they are not very much interested in new investments. Say it in other words, it's proper to say they don't have these investment ideas and those lots of investment opportunities. So the bigger the company, the closer it could be to the exit stage in the life cycle, the lower would be their investment appetites and opportunity to invest, and the lower would be the financial leverage of a company. We also can provide additional argumentation for that statistically significant negative relationship, saying that maybe those companies, because they already have debt in their history and they still have debt not repaid, it will mean that they have more assets under the collateral already used, and so they cannot provide additional valuable assets for new collateral for the new senior debt. And in case they cannot do it, they need to go into the subordinated debts, and then it will mean that the required rate of return of these debt holders, new debt holders, will become higher, and the cost of debt is becoming higher, and that's why they are not willing to get this additional debt at all. How about the relationship between the leverage and the structure of the asset, which is called tangibility on one side, and the profitability of the company on another side? When it comes to the tangibility, in most cases, the researchers which are trying to verify whether trade-off theory really holds in the practice of some particular types of firms in different countries, they will get in their empirical research statistically significant positive relationship. And they will say that tangibility means that the companies will have a high proportion of tangible assets compared to the total average assets of the company. So the higher that coefficient which measures the tangibility, the proportion of tangible assets, which are potential collateral assets for debt contracts, the higher could be the level of financial leverage. And those companies which have high proportion of tangible assets, represented, of course, with the property, plant, and equipment, they will suffer relatively smaller loss in their value in case of the cost of financial distress. And for them, it is more difficult to substitute the risk profile of the assets because these are huge, long-lived assets, really expensive, and these tangible assets are not very easy to change quickly. So these are the argumentations saying that the companies with the high tangibility of their assets will have less sensitivity to the cost of financial distress, so they can permit for themselves higher levels of financial leverage. When we're looking at the relationship of the leverage and the profitability on the other side, we again can say that if the company follows this trade-off mode of thinking, trying to find the proper balance between the marginal costs and marginal benefits of the debt financing, so then the higher the profitability of the company, the higher would be the motivation to get the tax shield, and the tax shield becomes even more valuable. If the company has very low profits, the value of the tax shield is not as attractive as if the company has really higher profitability. So that's first explanation why the relationship would be really positive if your logic is to find the balance between the value of the tax shield and the value of the cost of financial distress. And for those companies which are profitable or they have higher profitability than some other companies in this sample you are observing, then the cost of distress for them could be, of course, lower due to the amount of profits they regularly earn. This is the final stage of our today's class and today's discussion. So I would like to summarize the magic of financial leverage and give you some takeaways from the topic, which was mostly focused on the trade-off framework and motivation behind capital structure choice. First, when summarizing, I would like to underline, to focus your attention on that first point in the slide. The capital structure decisions, of course, affect value. And trade-off theory just shows us directly that the benefits of the debt that could be related to the tax shield may bring additional value to the company which has financial leverage in a capital structure. Next, what's also important, capital structure decision, of course, can create additional value if the company is really carefully following the target level of the capital structure and trying to escape the increase in the cost of financial distress. But the capital structure decisions can also change the distribution of the value between different types of investors, debt holders, and equity holders. And in many situations, the change in the value will be at the expense of the debt holders. Third, we may understand now, not only assume, but just be sure that the trade-off logic of capital structure choices does not fit to all types of the businesses, to all companies in all times. And it cannot be irrelevant to the changes in the industries, to the new trends in the product markets, and of course, to the new trends in the business models, especially if those trends are related to the knowledge companies, dynamic capabilities, and as I explained to you in the first topic, they will lead to the appearance and the spread over of so-called living firms or knowledge firms. Those types of companies must be very, very sensitive to the costs of financial distress. So for them, that trade-off logic of financing will say that they must be really conservative in making the decisions about their debt in a capital structure. Fourth, as I already mentioned several times, the researchers continue searching for what? For the verification of the trade-off for different countries, especially for emerging countries, because the market here has some very specific features. When doing the empirical studies, the researchers, of course, are searching for the determinants of the speed of adjustments, for the drivers behind the speed of adjustments. And of course, they are trying to verify and to understand and to formulate the patterns of adjustments in different markets and compare the developed ones to the emerging capital markets. And of course, the researchers continue searching for the impact of different types of industries and even periods in the history of the economic events in some particular countries and nations. To continue extracting or deriving the lessons from today's class, we need also to say if some company follows the trade-off framework or motivation behind the capital structure choices, then financial managers, they should determine the role of the tax shields, especially looking at the interaction of different tax rates, corporate and personal tax rate. In each country, there are different legislations, and this legislation through time may and also change and really changes. So the financial manager could not escape understanding how the interaction of the interest tax of the tax rates can impact the decision about the target level of the debt. Of course, those managers from the companies which think it's worth thinking about the marginal cost of debt and the marginal benefits of debt, or thinking in terms of trade-off framework, they need to understand the target capital structures of their companies, and they need to understand how the target level itself will change through time, because it would be moving target level of the capital structure. Of course, they need also to understand the specific speed of adjustment and the drivers behind the speed of adjustment. So they need to do it because they need somehow to model the potential result, the potential effects of the increase in the level of financial leverage. When doing so, especially modeling the potential impact, they should be very cautious about the indirect costs of financial distress, and even they need to understand how the long-term policy based on the trade-off framework of capital structure choices can affect their corporate market strategies. Why? Because as we showed before, the cost of financial distress means that the behavior of the financial stakeholders may change, as well as the behavior of their non-financial stakeholders also may change. So the extent to which both types of the stakeholders will change their mode of thinking and their styles of decision making in the company and around the company with a very high level of debt in the capital structure and high impact of the cost of financial distress over the business. So the extent of this event should be foreseen or forecasted or understood by the financial managers in the real life business. And finally, of course, we need to say not only executives should think hard about the long-term financial policy and its consequences. Those are the members of the board also who should account for these changes in behavior of equity holders, debt holders, and the non-financial stakeholders when developing the corporate strategies of the company. And of course, we already discussed and finished that part. And as always, I wish you a success to go through that topic and overall through the course in corporate finance.